Okay, hello everybody, and welcome to the second in our two-part series on multi-currency accounting. In today's webinar, we're going to cover the transition from single currency accounting in Brightpearl to multi-currency. If at any point during the webinar you want to ask questions, then just pop your questions in the box on the GoToWebinar panel, and I'll try my best to get to them during the session. Otherwise, we'll have a Q&A at the end. We're recording this and we'll send an email around to everybody after the webinar. So let's kick off. What we're going to cover today is a brief recap of how multi-currency accounting works, how to activate multi-currency accounting on your account, and then a bit of information around bank accounts and balances, and then transferring customer debt from base currency to foreign currency. So if you missed our last webinar, which went into detail around how multi-currency accounting worked, then best thing to do is to download the PDF guides. You can see the link there. Easiest way to get to that link is to Google Brightpearl Introduction to Multi-Currency, and also watch the first webinar, and the link to the first webinar is there. So the first thing we need to do once we've activated multi-currency is to set up foreign currency bank accounts. This is not a required step. If you don't actually have foreign currency bank accounts, you can still raise foreign currency invoices for your customers and pay foreign currency invoices from your suppliers out of a base currency bank account. But if you do have foreign currency bank accounts, this is what you need to do. So a couple of things before you actually create these bank accounts is just to understand the rules around multi-currency banking. If you've created a foreign currency bank account, then every transaction that you use that account for has to be in the same currency as that bank account. And a bank account can only be assigned one currency. So there's a bit of a restriction there in that you can't use foreign currency A to pay foreign currency B. You'd have to move the money through a base currency bank account. For the purposes of this webinar, I'm going to assume that you are a sterling merchant. So pound sterling is your base currency, and we'll probably use euro and dollars as foreign currencies. If you're in the US, then obviously the principles are reversed. So Brightpearl foreign currency bank accounts are good for reflecting what in the real world would be a foreign currency bank account. However, if in the real world you have a currency exchange management service that handles the whole pool of different currencies, Brightpearl foreign currency bank accounts are not great for handling those because they only hold one currency. Perhaps the best way, depending on your specific case, is to manage your exchange rate management services by converting the values to base and using a base Brightpearl bank account, which is probably what you're doing today. Once you've created a foreign currency bank account, you need to transfer your balances from the base currency bank accounts that you're using today. So not everybody creates a base currency bank account in Brightpearl to reflect their foreign currency bank accounts, but most of you who are using Brightpearl accounting already are probably doing this. So in this example, what we've got is a £50 sterling balance on a fake foreign bank account, as it were, in Brightpearl, because up until today, we didn't support foreign currency bank accounts. But when we go and look at our bank statement, we see the balance for that particular bank account is actually $61.50 US at an exchange rate of 1.24, say. So the current sterling value of that dollar bank account is $49.50. We want to reflect this difference when we build up the balance on our dollar bank account, and we want to clear down the balance of 50 on the old bank account that we're not going to use. So we'll transfer the amount across, and then create a bank payment to write off that difference, and then we'll deactivate the old bank account. So let's have a look at that in Brightpearl, see how it works. I'll pop along to the accounting list bank account screen, where we can see that I've got an old dollar bank account. Now, this was created and used in the days before multi-currency was activated on this particular account, so it's only got sterling transactions. What I've done is I've just created a new dollar bank account, and because my system is in multi-currency, I can actually assign dollars to that bank account. And I'll just quickly show you where you do that. So you can edit the nominal code and choose the currency for that bank account. You can only do this if the bank account has not had any transactions. So as soon as you've started transactions in a bank account, you can't change the currency. So let's do a transfer. We're going to transfer from the dollar bank account, which was the old one, into the actual new dollar bank account. So from our converted to our USD bank account, and I think it was 49.60 at a rate of 1.24. So that will put 61.50 US dollars into our US dollar bank account. Let's just put the useful reference in here. And if we now go to our bank account list, you'll see that our US dollar bank account reflects the real world value of $61.50. But there's this 40p left over that we just need to get rid of. So we'll just do a bank payment into my exchange rate gains and losses account. And let's just call that writing off foreign exchange loss or gain. So our bank account will now be zero. All of our balance will be on our US dollar bank account. What we want to do is now deactivate this one. That will no longer be available to use for creating new transactions. So that's the process of creating foreign currency bank accounts and transferring the balance. Pretty straightforward, I hope. If you've got any questions, of course, just pop them in the chat and I'll come to them. So the next thing, which is the more complex thing that you might need to do when setting up multi-currency, is transferring your existing customer balances or supplier balances into the right foreign currency. It's important to mention that this is not essential. This is only something you want to do if you want to move all of your historic data, effectively your open invoices, across to foreign currency. If it's closed and paid, it has to stay in base currency, but if it's still open unpaid debt, which you've converted to base, you could bring that back into foreign currency to continue managing further payments. Regardless of whether you do this or not, any new invoices for your customers and suppliers will just be purely multi-currency. So this is only to help you through the transition phase. It would help if you wanted to send foreign currency customer statements to include any existing balances that they've got. Also, by moving your foreign debt into the respective currency, it helps you track exposure to exchange rate gains and losses using the exchange rate gain and loss report in Brightpearl. And it also means that it's all in the same place. So it's a clean cut. A certain customer, perhaps trading in Europe, would then have all of their debt in euros, rather than half of it in sterling during the transition phase and half of it in euros. However, there are a couple of downsides to transferring your balances. One is that you're going to have to re-invoice this debt, so create new invoices, and that means that the invoice references on their statements won't match the original invoice references. If you can send specific affected customers an email to let them know, then maybe that's not a problem for you. But I know for some people that will be a problem, and you'll have to make that decision yourself. There's another downside, which is that it takes a bit of time to do. It's a manual process to transfer the debt across. It's not a huge amount of time, but if you've got lots of debtors and lots of invoices, then it might take more time than you like. So yeah, up to you whether you want to do this. What I'll do is I'll show you how. The first thing we need to do is add a currency transfer account. Now this is a bank account in base currency, and we use this to move money around the system. It's not a real bank account, it doesn't reflect anything that happens in real life, and it's purely there for transfers. It's actually a useful thing to have in a multi-currency system anyway, so I'd recommend creating one. The next step is to print a statement for the given customer. This is the easiest way of viewing their foreign currency debt, here $150, and the sterling value which it was converted to at the point it was invoiced in the past. Because we're going to transfer this balance back into dollars, we might choose a different exchange rate. So here, for example, $150 invoice was captured with an exchange rate of 12537. But today's exchange rate is different, so actually we're going to end up with a different sterling value. So that's another reason for moving your foreign debt into the right currency, is that it more accurately values that debt in base currency. You don't have to use the statement. You could export perhaps a number of other screens into Excel to provide you with the data, but if you print out a physical statement, you can actually work through the balances perhaps more easily just with a paper and pen. So we've got a question here coming in from Teresa. It's quite a long one. She's asking, if you don't do the transfers, what are the downsides? Covered a couple of them on the previous slide, and I think those are really the main downsides. So once you've printed a statement, you need to clear off that base currency debt. We're going to then re-invoice it in a foreign currency. So you only clear off the debt that is for invoices that are actually created for orders or perhaps quick invoices already. Where you've got a payment on account for an order that is not yet invoiced, you need to leave that in base currency, because the invoice, when that is later invoiced, needs to match up against it. So leave these transactions in base currency and only transfer the balances that have actually been invoiced or credited. In this case, it's only the top line. Pay it in full, and then use the currency transfer account you created. I'll show you all of this actually in a Brightpearl account as well. We're just going to run through the processes quickly with slides. So we're going to clear the base currency debt, and then we need to re-invoice in the foreign currency. Using the quick invoice, choose the customer, choose the respective currency, pop in the exchange rate you want, add the original invoice reference in, so that when you're doing a quick search for that old invoice reference, it'll bring up both the old invoice and the new one, and choose your currency transfer account. I also suggest you choose T9 or not rated, because there's no VAT applicable. The VAT will be reflected on your original invoice. So it's probably a good idea, in fact I think it's probably essential, you also choose the same date that was on the original invoice. The original $150 order at that exchange rate gave us 119.65 sterling. But when we choose to move it to foreign currency, we're going to use today's rate, which gives us a different base currency. So we've actually gained money. That will appear on the currency transfer account, which we then move across to the exchange rate gains and losses, much like we did with the bank payment when setting up the bank transfer for setting up the bank balances. So once you've re-invoiced all of the separate base currencies, they're going to be in foreign currency against that particular customer. There'll be a remaining balance on that transfer account which you need to clear off. The end result should be zero balance on the currency transfer account, and it's probably a good idea to clear off that balance for each customer rather than after all of your customers. You could do it on a per invoice basis, but I don't think that's suggested. I don't think it's a great idea. Okay, let's go and have a look at this in Brightpearl. If I go to my customer debt screen, you'll see that I've got 119.65 sterling. That is base currency debt created from a foreign currency order before multi-currency was turned on. So I raised an order for $150, I sent the customer an invoice for $150, but it's reflected in my accounting as 119.65 sterling. I want to move that back so that it says $150. Let's go to my bank accounts, just so that you can see the currency transfer account. It's base currency bank account, nothing special about it. Let's go into allocate payment for this customer, and here's where I could print a statement. Just pop that in a new tab, and here you can see the foreign amount and the base amount. If they'd only part paid that invoice, it would still show the full dollar amount. We don't prorate that here, so you'd have to prorate that manually. We'll choose the currency transfer account, choose to pay it in full, and submit. So that's cleared their base currency debt. We'll go to the bank accounts. We'll see our currency transfer account is now holding that balance. We are going to then raise a quick invoice for this particular customer. Choose the currency and then choose the exchange rate. Put the old invoice reference in here, which is SI 100,000, and then $150. Make that not rated. The important thing is to choose your currency transfer account here. And that's pretty much all we need to do there, is enter the invoice. If we now go to the customer debt, we'll see that we've got the new base currency equivalent for that debt, but if I filter this to show the dollar debt, we're reflecting $150. If we go into that customer, you'll see that the financial balance is now $150, where previously it was 119.65 sterling. So I've transferred that contact balance from base currency into foreign currency. From the bank account list, you'll see that there's 132 left over. What I need to do is move that across to the currency exchange rate gains and losses. So let us receive money in because this balance is negative. And we will use exchange rate gains and losses. Oh, I forget the balance. What was it? 132. Exchange rate gains and losses. T9, 132. And enter the receipt. That's okay. And our bank accounts will now show no balance on the currency transfer account. So that's the balance transferred. Let's have a quick look to see what that search brings in. So if I search for the original invoice reference, I think it's that, we'll see both invoices appear. So here's the original invoice in base currency, and you'll see because this was done before multi-currency was activated, both sides of the accounting are in base currency, so 119.65. The accounting system has no awareness that the original order was $150. We then cleared down that debt, which is the second transaction in here, clearing that into the currency transfer account, and then we re-invoiced at $150 with multi-currency on, which meant that it was a dollar transaction with a base amount reflected there. So hopefully that explains how to transfer balances across from base to foreign. I'm going to get to a couple of questions at this point. So now, here we go. On the aged debtors report, can you filter to show all the currency debts, not just one currency at a time? No, you can't. So if you go to aged debtors, the default view is all of your currency debt, but the base currency values of it. So even though this shows £120.97, that represents $150. And if you had another customer with a euro balance, another customer with a yen balance, all of those customers would be showing on this default screen with the base value of that debt. And that's because the total base value of this screen needs to match the assets on your balance sheet. So 120.97 will match the debtors control account on your balance sheet, which is all base currency. It's only when you filter to show debt for a certain currency that you actually see the dollars or the euros. And in fact, if I filter to show just sterling debt, there won't be any, because that particular invoice is a dollar invoice. So that was transferring from base to foreign. If we go and have a look at the exchange rate gains and losses nominal code, you'll see the two transactions that we've brought in. First one was as a result of setting up the bank account, and the second one is as a result of transferring debt across to a customer. Now, because this debt is now in the foreign currency, that $150, we want to go and have a look at the unrealized gains or losses for it. So we chose to invoice that $150 at a 1.24. However, the latest exchange rate on my system is 1.3. So if the customer now paid me $150 at 1.3, I'd receive $115.38. So I've actually made a loss. And this is one of the benefits of transferring your foreign debt into the respective currency, is that this report will show you the exposure or the variance or the loss that you'd get, or the gain, if all's well, if they paid you in full in the foreign currency. Another good reason for doing it is the ability, let's just go into dollars, to take foreign currency payment. So if you hadn't converted this to foreign dollars, what you'd have to do is do all the conversion to base. But because this is now in dollars, you can pay it in dollars into a dollar bank account, and you're operating entirely in foreign currency. So that's another good reason to do it. So, final thing to mention today, it's not a particularly long webinar, is that while you're setting up your multi-currency system, it might be worth adding a separate exchange rate gain and loss account for each currency. So let's switch back to Brightpearl, and we briefly saw it. I've been using the 7700 exchange rate gains and losses account. That's the one that we set up by default. Your system will have some exchange rate gains and losses nominal code, and you can choose that on a per currency basis by going to settings and currencies. You can actually filter general ledger and other reports by currency, so you could extract the information you need for a certain currency without creating separate nominal codes. But if you want, you can create separate nominal codes to make it easier to see on the profit and loss report. So, we've got a couple of questions coming in. If you don't transfer your foreign debt into the foreign currency, then business as usual as you're doing it today. So let's have a look. If we go to our recent sales, open up that order. This foreign $150 order came in at $119.65. What you'd do is you'd have to figure out the base value you wanted to clear against that invoice. So if they paid you $150, you'd choose whether you recorded that as $190.65 or a different adjustment amount. But I think that's outside the scope of this webinar, because that's how Brightpearl operates today. I think the best thing to do is raise a support ticket there, and we'll cover a bit more information, a bit more detail. Sarah's asking, can we see bank activity and bank reconciliation screens? We'll show you that at the end. James is asking some rounding questions. We'll come to that at the end. So I think it looks like pretty much most of the questions here are going to be covered in FAQs. So what I'll do is I'll end the webinar here, stop the recording, and then we'll drop into a questions session. Thank you for joining, everybody, and we'll put the recording online shortly.